Welcome to today's episode of Boss Economics World. I'm glad you're here because what we're diving into today is no simple storm in a teacup. No, what we have on our plate is a gigantic economic iceberg that's been brewing for decades, steadily derailing Europe's ambitions, and believe me, the road ahead looks rather grim unless there's a proper wake-up call. The IMF, yes, the same international monetary fund that operates like a sort of financial fireman for economies in distress, just threw down some pretty dire warnings. You might have already heard it in the news. The gap between the US and Europe's gross domestic product, GDP, is expected to widen further over the decade, a trend that has economists on both sides of the Atlantic breaking into cold sweats. Before we get into the nuts and bolts, though, let me spell this out: the IMF isn't just giving a little slap on the wrist here. No, this is more like a neon flashing, danger, do something now sign directed straight at Europe. The central problem the IMF identifies? Europe has a business dynamism problem. The continent's growth engine is essentially sputtering, while across the pond, the US seems like it's greased its growth wheels just fine. Now, let's break that down and analyze what's going on here because this kind of wide-encompassing issue is always multi-layered, and we need to go from point to surface. We'll hit on key issues like productivity, investment, technological inertia, aging population dynamics, and more, and, of course, backed by the latest data. So, let's dive into how things stand and dissect the situation systematically. Let's get the first big red flag out of the way: productivity. Europe is stuck in the productivity mud while the US is racing ahead. To cite the IMF's recent data, GDP per worker in key European economies, Germany, France, Italy, Spain, was on par with the US back at the start of the millennium. But today, that picture looks very different. Income per worker is now a whopping 20% lower than in the United States in these same countries. That's not just a gap, it's a canyon slowly widening with time. Productivity in Europe has stagnated across all sectors, but the technology sector reveals the deepest scars. According to the IMF, since 2005, tech productivity in Europe has barely moved, while the US has enjoyed almost 40% growth in the same sector. The numbers themselves are staggering. It's like Europe is still using dial-up while the US rockets ahead with fiber-optic internet. The divergence here is emblematic of something far bigger than raw numbers. It points to fundamental issues in how Europe incentivizes and adopts new technologies, or rather, it seems, fails to. When you hear words like innovation or tech revolution, you can almost feel like you're landing in Silicon Valley with those flashy names like Apple, Google, Microsoft, oh, and let's not forget the Tesla of the AI and tech world, OpenAI. But Europe? Its tech scene just doesn't ignite the same imagery. By all measurements, the US consistently leads in areas like venture capital funding, tech innovations, and digital transformation. At this point, it is crucial to bring in some real-world examples that punctuate Europe's tech stagnation. Europe failed to build prominent, world-leading tech giants on the same scale. Where's Europe's Google or Tesla? Especially in artificial intelligence, quantum computing, or green tech, which is set to drive future growth, the US has soared miles ahead, which is reflected in venture capital inflows. In fact, venture capital, VC, investment in Europe is just a quarter of what we see in the US. It's a painful truth that fewer startups, and less funding for the few that exist, imply an inevitable slowdown in innovation across industries. Contrast that to the US, where technology adoption across the economy has skyrocketed. From AI in healthcare to digital payments in finance, the US is integrating innovations far smoother, and it's reflected on its balance sheet. Last year, tech-based sectors in America contributed nearly 9% to the nation's GDP, bolstering overall productivity. If Europe wants a tech reawakening, it's not just about policies, regulations, or catching up with short-term trends. It needs to think generationally, investing in STEM education, science, technology, engineering, and mathematics, and creating a prosperous environment for tech-centered venture capital. Otherwise, in a decade's time, that productivity gap will feel impossible to close. Here lies another underlying anchor weighing down Europe's progress. In case it wasn't clear yet, Europe also has a severe lack of capital dynamism, which again speaks to the business dynamism problem that the IMF harped on. Venture capital, VC, private equity, IPOs, whatever metric you use to measure capitalist energy, Europe lags far behind. Venture capital in the US is not only more prevalent but more ambitious. According to the European Investment Fund, VC investments in Europe amounted to only $11 billion, $12 billion in 2023, compared to a US figure of around $229 billion for the same period. That's not a small difference, it's crippling asymmetry. One key metric often used to measure an economy's dynamism is the number of new entrants, i.e., startups. In Europe, the percentage of companies that are just 5 years old or younger is half of what it is in the US. The venture capital sector, which funds these dynamic small players, is stuck in neutral. Now, think about this, these startups represent tomorrow's Amazon, Apple, Alibaba, or whatever dominant tech giant might shape the coming decades. If we don't have fresh sprouts today, there won't be towering trees tomorrow. Aside from entrepreneurship woes and access to capital, it's also clear business investment overall has stalled in Europe. The International Energy Agency reports that Europe's green tech investment target is falling short, while stats from Eurostat show gross fixed capital formation, which includes business investment, has been stagnating across most of Europe over these last few years, meaning less future capital growth. Let's not sugarcoat it, another big reason dragging Europe's growth down is the demographic decay it simply cannot avoid. In 2023, more than 20% of Europe's population was aged 65 or over, and this figure will swell to nearly 33% by 2050 if no changes occur. Now, what we have here is the makings of an economic time bomb. If you have fewer workers entering the labor force, there's less economic efficiency, less money being pumped into the economy, and immense pressures on pension systems. Economists often refer to this as a gray tsunami. Comparing Europe and the US in terms of labor productivity, there are critical observations. Running against the trend in the US, where overall workforce participation is still relatively robust, Europe's workforce is shrinking incrementally. Let me just throw this out there, it is projected by Eurostat that between 2020 and 2050, the working-age population in Europe will plummet by around 50 million people. This is equivalent to nearly 14% of the European workforce disappearing into retirement in just 3 decades. Moreover, Europe is also behind in the industries that can accommodate an increasingly aging population. Healthcare innovation, biotechnology geared at aging populations, automation projects aimed at improving late-life care. Most of these projects thrive on the venture capital ecosystem and flourishing entrepreneurial culture, things that Europe misses out on. An aging labor force coupled with sluggish technologies doesn't just spell slower growth, it calls for economic stagnation. At this point, you might be asking, why, if these problems are so clear, hasn't Europe done anything significant to tackle them? Well, there's no single silver bullet, but poor structural integration within the European Union is undoubtedly part of the mess. The IMF echoes Mario Draghi's recent report calling for closer European integration, particularly in the fields of capital, goods, and services. And believe me, while this sounds easy to propose, it's much harder to roll out. The problem, as IMF Director Alfred Kammer notes, is vested national interests. Europe is a patchwork of individual states, each with its agenda, its politics, and most importantly, its sovereignty. German industry interests do not always align with Spain's, and not everyone on the continent agrees when integration should happen or how deeply. More than that, individual member states tend to guard their borders zealously when it comes to economic reform, and this creates policy bottlenecks that block continent-wide strategies from flourishing. Economic integration at a higher level would mean easier cross-border investments, more seamless services, and less rigid labor market structures. In short, a truly united EU economy could spark a productivity revolution. Yet, national egos and technocratic considerations slow down this very necessary and urgent process. Now, let's dive into another critical structural issue, overregulation. Europe's regulatory policies are notorious for their complexity and rigidity. And while regulations are often rooted in good intentions, such as protecting consumers, workers, and the environment, they tend to suffocate innovation and entrepreneurship when poorly designed or overly bureaucratic. According to a report published by the European Commission itself, the EU has some of the most complex regulatory environments globally, which tends to inhibit innovation. This regulatory burden makes it much harder for new businesses, especially tech startups, to grow, enter new markets, and challenge established players compared to the US, where regulatory barriers, though present, are far less stifling. Take, for instance, the European tech sector, which bears the brunt of this regulatory chaos. The digital single market, a long-promised initiative to break down regulatory barriers for digital businesses across the EU, has seen limited success. Despite some progress, digital markets in Europe remain fragmented, with national regulations in individual countries creating hurdles for startups that want to scale across borders quickly. What should be a gigantic unified market of 450 million people often feels like it's broken down into 27 smaller puzzle pieces, while the US offers tech entrepreneurs a single, regulation-light market of 330 million people. And let's talk about another European hallmark, data protection regulations, particularly the General Data Protection Regulation, GDPR, which has become the gold standard for data privacy worldwide. However, while GDPR's intention to protect consumer privacy is commendable, its complexity and compliance costs have derailed many startups and even medium-sized companies that manage global data. According to a study by the Information Technology Innovation Foundation, it's estimated that GDPR compliance costs reduced venture capital investment in European tech startups by anywhere from 26% to as much as 50%. Imagine what this does to Europe's ability to foster game-changing tech firms. Europe's heavy-handed regulatory frameworks serve as extensive hurdles compared to the relatively laissez-faire regulatory environment in the US, where "move fast and break things" still rings as a mantra for disruptive innovation in Silicon Valley. This chunks neatly into the final core point: structural policy reform is not just desirable at this point, it's indispensable. The IMF and numerous European think tanks argue that the continent's economic strategy needs a fundamental overhaul. The failure to address key reform areas should sound a global alarm, especially as global competition from emerging economies, particularly China and India, is intensifying. China's assertive climb up the value chain is already threatening European industries across sectors from tech to manufacturing and renewable energy. In 2023, China surpassed the EU as the world's leading source of renewable energy investment, attracting total investment of over $546 billion, dwarfing the entire European Union's $156 billion. The long-held assumption that Europe is the global leader in green energy is now being challenged, and the vacuum left by ineffective European policies could see Asia leapfrogging the continent in these industries. India, with its dynamic workforce, robust service sector, and rapidly growing tech and manufacturing prowess, is also giving Europe sleepless nights. Projections from PwC suggest that India will surpass Germany in terms of GDP within the next decade, consolidating its position as a technological and economic powerhouse. The bottom line: if Europe doesn't reinvigorate its policy structures to streamline business environments both in technology, services, manufacturing, and even cross-border trade, other regions will fill the gap in global markets left by Europe's economic stagnancy. Let's not forget the elephant in the room: political fragmentation inside the European Union. The lack of uniform political will across European states is almost as damaging as the lack of economic integration. Yes, it's easy to blame bureaucratic inefficiencies, but, at its core, Europe's economic struggles are as much about political coordination as they are about economic shortfalls. Many of the EU member states seem unwilling, or unable, to sacrifice enough political sovereignty to allow Brussels to carry the torch on economic policy. Even the IMF's own statements seem cautiously optimistic at best. Alfred Kammer, head of the IMF's Europe Department, noted that national and vested interests are holding back progress despite the broad acknowledgement of the solutions. This is not new. Political gridlock between Europe's heavyweights, France, Germany, Italy, and its periphery, Eastern and Southern European nations, often results in a mishmash of half-hearted compromises and watered-down policies. In recent years, the rise of Euroscepticism and populist movements further complicates efforts at deeper integration or significant structural reforms. With parties like Italy's Lega Nord, France's National Rally, and the Alternative for Germany, AfD, both gaining ground domestically, their anti-EU rhetoric threatens to derail necessary reforms. For example, pension reform is a major battleground in France, one of Europe's largest economies that faces the same demographic challenges mentioned earlier. When President Emmanuel Macron attempted to tackle this pressing issue, his proposals were met with fierce resistance and widespread strikes. This is emblematic of how deep structural reform is met with internal backlash not just in France, but across Europe wherever similar issues are dealt with, as implicitly acknowledged by the IMF. On top of this, political fragmentation is compounded by the North-South economic divide that has existed ever since the Eurozone crisis of the early 2010s, where countries like Greece, Spain, and Italy struggled while Germany and the northern economies thrived. The challenge has always been, and remains, about how to harmonize economic policies across such a diverse spectrum of national interests. So, what can Europe truly do to buck these trends? The IMF makes it clear: deeper integration, especially in the single markets for goods, services, and capital, is crucial. The European Union was built on the promise of creating one of the largest unified markets in the world. In reality, we still see a highly fragmented market where bureaucratic inefficiencies prevent Europe from unleashing its full economic potential. Elements of the European single market are undoubtedly among the most successful projects of the EU, breaking down barriers and facilitating cross-border trade, travel, and investment. However, progress has been uneven and is far from a full success, particularly when it comes to services and capital markets. The single market in goods may be somewhat integrated, but the market for services is fragmented, which is problematic since the service sector comprises over 70% of Europe's GDP. Moreover, capital, an essential ingredient for growth, still faces obstacles moving across borders. This leads to inefficiencies, such as businesses struggling to finance their operations and expand across Europe. A more integrated capital market would enable better access to funding, boost investment, and support innovation, a key IMF recommendation that echoes Mario Draghi's far-reaching report. Could more cross-European collaboration help re-energize lagging economies? Absolutely. Major infrastructure projects, like decarbonization initiatives and digital infrastructure, offer real opportunities for economies of scale, but only if the EU governments can act cohesively and leave behind petty turf wars. Estimates from the European Investment Bank, EIB, suggest that Europe needs more than €1 trillion in additional capital investment by 2030 to meet its climate and digitalization targets. Yet, these initiatives often fall prey to member states lobbying for national protections that hinder more active EU involvement. If Europe has any chance of catching up with the US, a massive coordinated effort is necessary, ranging from fiscal stimulus in high-growth areas like technology and clean energy, to targeted reforms in services and capital markets. Let's not beat around the bush here. The IMF's somber forecast is bleak, but it could be the shot of adrenaline that Europe needs. At the heart of Europe's problem is a lack of business dynamism, weakened productivity, and an inability to integrate policies across countries swiftly and effectively. The US, with all its flaws, shows what can happen when integration is combined with innovation and a light touch on regulation. Money flows where innovation thrives, whether in tech, services, or capital markets. But in order to reverse this tide, Europe's leaders need to make some hard choices, and fast. These include tackling demographic shifts via immigration reform, reinvigorating the venture capital landscape, reforming restrictive employment laws, and unleashing its latent technological and entrepreneurial potential through fundamental reforms. Will Europe seize the opportunity? History doesn't offer much comfort, but with pressure from institutions like the IMF mounting, and global competition not slowing down for anyone, there has never been a more critical time for Europe to truly address these challenges. If Europe waits too long, the widening gap between its economic performance and that of the more dynamic US and rising Asian economies might become a chasm from which recovery would take decades.